Alrighty then, Econ 100. Welcome to Macro Measures. This is our first lecture in Act 3, the big picture. We made it to the big show, macroeconomics. So here, the first thing we're going to do in macro, we're going to talk about our macro measures. So just like other social sciences, there's two sides to economics. There's the empirical side or the data side. That's what we're going to be talking about here today. And there's the theoretical side. And they live off of each other. It's like a symbiotic relationship. They need each other. The name of the game, you put out a theory, you test it with your empirical evidence. What you like, you keep. What you don't like, you change. You test the theory, or you put out a new theory, you test the theory with the evidence, you put out a new theory, you test the theory with the evidence, and you're supposed to progress that way. The science, the social science, and our understanding is supposed to progress that way. So before we get to the theories, we need to talk about the different macro measures, the different macro variables we use to test those theories. We're going to look at the different macro variables we use to measure the health of the economy. So there's going to be kind of three broad categories. We're going to look at GDP, which is going to include both or all three: income, expenditures, and production. Then we're going to look at prices, focusing on mainly the CPI, the Consumer Price Index. That's our second category. And then our third category is going to be our labor market variables. And the star of the show will be the unemployment rate. But first here, we want to talk about GDP. So what is GDP? GDP is going to stand for three things simultaneously: production, income, and expenditures. So it's all the money spent, all the income earned, and all the goods and services produced. How can it be all three of those? Because we make up the rules. Well, not we, the BEA, the Bureau of Economic Analysis. They're the ones that handle this in the United States. So they set up the accounting rules so that that's true. So why do they do it that way? It's the idea that everything produced is going to be income for somebody and an expenditure for somebody else. So we're going to start here with our first category, GDP, looking at income, expenditures, and production. Now, what is the definition of GDP? I know definitions can seem boring, but our definition is important here. It gives us our accounting rules. GDP is the market value of goods and services produced within a country's borders during a specified time period. So that gives us the accounting rules of GDP. Now I'm going to go through, I'm going to break that definition down. I'm going to tell you what the different parts mean. But GDP is often talked about as the size of the pie. We can also divide it by the number of people and get GDP per capita, which is the average slice of the pie. And when you're talking about standards of living, we usually use GDP per capita to represent that. That's the most common measure that we use to represent that. So the average slice of the pie, that represents our standard of living. The average amount of goods and services we can buy based on the average amount of income we earn, which is based on the average amount of production or our productivity. So we have GDP here, the market value of the market value of final goods and services produced within a country's borders during a specified time period. So now, what do we mean about market value? Well, we turn things into dollars here in the United States, which allows us to compare apples and oranges or apples and cars. So how much is something worth in terms of value? So we're looking at production, but we're looking at production in terms of market value. So say you have two countries, and one country produces, 100 million apples, and you have another country that produces, say, 10,000 cars. Who's more productive? Well, 100 million apples is a lot of apples, but cars are much more complicated to produce. So what do? You go out and you sell them. Whichever one brings in more dollars, that's more production. So we want to turn things into market values. It allows us to compare very different products. It allows us to add them all together to see the total level of production. So we put things in terms of market values. So what's my value to the market? It's not what I think I'm worth. It's what I can get, right? I'm talking in terms of labor, me as a professor. What am I worth? That my market value, it's what somebody's willing to pay me. All right. So we have market value, final goods and services, What do we mean by final goods and services? That's as opposed to intermediate goods and services. We want to take intermediate goods and services out so that we're not double counting. So let's say you have, I don't know, you have Tropicana, right? And they go out and they buy $1 million worth of oranges to turn that into $3 million worth of orange juice. The $1 million that Tropicana buys, the $1 million worth of oranges that they buy, that's not going to count towards GDP. It's an intermediate good. Why? Because the $1 million worth of oranges is going to be included in the $3 million worth of orange juice. So if we counted the $1 million worth of oranges and the $3 million worth of orange juice, we'd be double counting the $1 million. And so Tropicana buying $1 million worth of oranges to turn it into orange juice doesn't count. But I don't know, say I just like oranges, or I'm worried about getting scurvy, so I want to get some vitamin C, and I go and buy a $5 bag of oranges. That's going to count towards GDP. That is going to be a final sale to me. So our goods, I should say, those are tangible things. So shirts, shoes, hats, bread, eggs, milk. Our services, those are intangible. So intangible things, you go to a concert, you go watch a movie, you pay somebody to do your taxes or clean your car, something like that. So our goods are tangible, our services are intangible. We only want final goods and services. We take intermediate goods and services out because we want to be good accountants. We don't want to double count. What might an intermediate service look like? I don't know, you hire a contractor to do something on your house and they subcontract part of that. So the contractor pays the subcontractor. Well, you wouldn't want to include the subcontract because that's going to be included in the final contract to you. So we have market value, right? We have our final goods and services as opposed to intermediate goods and services. We take those out. Within a country's borders during a specified time period. Just like every game, we need boundaries. We need time boundaries and we need geographic boundaries here. Okay, so GDP, the way you can think of it, it's everything produced within a country's borders, no matter who produces it. So it's like the health of a geographic location. There's a closely related measure called GNP, gross national product. You can think of that as everything a country produces, no matter where it produces it. So GNP, everything a country produces, no matter where it produces it. GDP, everything produced within a country's borders, no matter who produces it. So if Germany is producing cars in the United States, it counts towards the United States GDP, but it counts towards Germany's GNP. So gross domestic product here, GDP, it's everything produced within a country's borders. Now, during a specified time period, we account for GDP quarterly. So that's the highest frequency that you can get it. You can get it quarterly. So you can look at GDP quarterly or you can look at it annually. Now, another thing I want to say about time periods, we only include new production. So we don't include used or resold goods. This is a current measure of production. So if somebody produced a jalopy in the 1970s, that counted toward the 1970s production. If you resell that jalopy, and that's like a beat up car, if you're wondering what I'm talking about, it's like a beat up clunker. If we resell that here in 2023, which is what it is right now, we don't want it to count towards 2023 production. We want it to be a current measure of production. So once again, we have our market value, final goods and services produced within a country's borders during a specified time period. There's two main ways to go about accounting for GDP. Okay, we have what we call our income approach and our expenditure approach. So on the left-hand side, we always use Y to stand for GDP. Now, when we use uppercase letters, it's the level of the variable. When we use lowercase letters, that's per capita. So here we're looking at the level of GDP. So Y always stands for all three things: production, income, and expenditures. So it's like there's three sides of this triangle, right? So Y always stands for all three sides. Now on the right-hand side, we're gonna have two different sides of this triangle. So first we have our income approach. So my GDP on the income side, we have wages that we pay to our workers, right? Everything produced is income for somebody and expenditure for somebody else. So on the income side, so we pay wages to our workers, We pay rent for our land or our natural resources. That's how we classify it. We pay interest for our capital, and we pay profits to our entrepreneurs. Okay, on the expenditure side, this is the more classically studied side. This is what we're going to focus on. We're going to go through each one of these components in a few slides from now. But for now, our expenditure side, we have consumption, which is for most of our household goods and services, or household purchase of our goods and services. We have investment, which is going to have 3 buckets, but you can mainly think about it as firms purchasing physical capital, their tools, factory equipment, machineries. We have our government purchases, which is spending on all levels, state, local, and federal, with the exception of transfer payments. And then we have our net exports, which are our exports minus our imports. So again, it's the idea that everything produced is income for somebody and an expenditure for somebody else. And if you didn't believe me, I'm going to have a picture here to show that to you. This is what we call our simplified circular flow diagram. So here in our I simplify it down. Some people get really complicated with these things. I'm not trying to get you to memorize a very complicated circular flow diagram. I'm just trying to illustrate a point here. Okay, so I'm going to do a very simple circular flow diagram. So we're going to have 2 markets. We're going to have our markets for goods and services and our markets for our factors of production. We're going to have 2 sides. We're going to have our firms and our households, okay? So what you're going to see is our firms are going to pay income to our households for our factors of production in order to produce. So you're going to see the green. The green is the money. So the firms pay the household. They pay them wages for labor. They pay them rent for land and natural resources. They pay them interest for capital, and they pay them profits for entrepreneurship. And then the households are going to go right around and they're going to spend that money through the market for goods and services. They're going to be purchasing this production now, our expenditures. They're going to be paying the firms for consumption, investment, government purchases, and net exports. So that at the end of the day, right, income equals expenditures equals production here in our simplified circular flow diagram. Now, what do you notice about my circular flow diagram? It's really squarular, right? And so when I put this together, I actually didn't think about it. It's supposed to be a circle, but then when I did it, I just left it because I thought it'd be a good opportunity for me to make fun of myself.